Okay, let's jump right in. Welcome to today's Explainer, where we're tackling a milestone that is, well, it's equal parts thrilling and honestly a little terrifying. Buying a home right here in Arkansas. Taking that step is a massive emotional and financial commitment. But here's the hard truth we really need to establish right out of the gate. Relying on the sticker price alone when browsing real estate is a dangerous, dangerous game. If you're looking at homes without running the full numbers first, you are literally flying blind. So our main focus today is exactly why using an Arkansas mortgage calculator before you ever make an offer or honestly even start seriously house hunting is your absolute best defense against a whole lot of financial regret.
It's a simple question, right? Is your dream home actually affordable? But man, it can be a painful one to answer if you do things out of order. So many eager buyers fall completely head over heels in love with the property, they start imagining their furniture in the living room, and then they try to cram the math into their budget afterward. This backward approach is exactly how people end up seriously financially overextended. We really want to challenge those assumptions today. Finding out you can't afford a house before you tour it, that's smart. Finding out after you've set your heart on it, that is just devastating.
Because the sticker price, let's just say it's $300,000, is just the tip of the iceberg. It's only the part you can see floating above the water on a real estate listing. But beneath the surface of that purchase price is a massive, hidden block of financial obligations. If you commit to the tip of the iceberg without using a calculator to map out what's underneath, those submerged costs will absolutely sink your monthly budget. No question about it.
To see exactly what those hidden costs look like in reality, consider the number 0.76. That's 0.76%. What exactly is that? That is the estimated annual property tax rate for Pulaski County, Arkansas. Now, I know that might sound tiny, but when you apply that to a home's total value year after year, localized hidden costs like this silently and significantly inflate your budget. And get this, property taxes vary wildly. Benton County sits around 0.67%, while Washington County is 0.66%. You absolutely cannot guess these numbers, which is why a localized calculator is so crucial.
Section 1. Your monthly payment. Unpacking the costs.
Okay, so demystifying your payment starts with the mortgage principal. Think of this as the base amount of money you are actually borrowing to buy the home. When you make a payment against the principal, you're building equity. You're officially owning a larger fraction of your house. But, and this is a really big but, the principal is only one piece of the puzzle. It doesn't include the cost of borrowing that money or any of the extra fees required to actually keep the house.
Notice how your monthly payment isn't just one solid chunk. It's more like a pie divided into 5 very hungry slices. You've got your principal, sure, but then you have interest. That's the fee you pay the bank for lending you the money in the first place. Then come those local property taxes we just talked about. Next is homeowners insurance, which is mandatory to protect your investment. And finally, if you put down less than 20% on the home, you usually get slapped with PMI, or private mortgage insurance. And the kicker? That protects the lender, not you. It's a tough pill to swallow. A good calculator takes all 5 of these separate slices and combines them so you can see exactly how they're going to eat up your monthly budget.
Section 2. Test loan scenarios. Find your perfect fit.
You can really think of the calculator as a virtual dressing room. It lets you try on different financial hats to see what fits your lifestyle perfectly before you ever have to sit down and negotiate with a lender. For example, it empowers you to compare a 15-year fixed mortgage directly against a 30-year fixed mortgage. The 30-year gives you way more breathing room month to month, but it comes with substantially higher lifetime interest costs. The 15-year term tightens your monthly belt considerably, but you'll own the home free and clear in half the time, literally saving a fortune in interest. Seeing these numbers in black and white, it changes everything.
And you know, it's not just the length of the loan, it's the type of loan. You have some fantastic local options in Arkansas. You've got fixed-rate loans, which are perfect for long-term rate stability, and those usually require 3% to 20% down. But look at the alternatives. FHA loans are incredibly popular for first-time buyers because they only require a 3.5% down payment. Or, if you're looking outside the city limits, USDA loans for rural residents literally require 0% down, though, you know, they do have their own specific criteria.
So the crucial point here is that you have variables you can control. You can test loan amounts anywhere from $60,000 all the way up to $2.5 million. You can adjust the interest rate based on current market trends. You can tweak the loan term, and you can play around with your down payment. Tweaking just one of these variables, like maybe saving up just a little bit more to hit that magic 20% down payment so you can eliminate PMI entirely, that can drastically alter your financial future and free up hundreds of dollars a month.
Section 3. Hidden buyer traps. Avoid invisible hurdles.
Now, the biggest trap by far is misunderstanding your debt-to-income or DTI ratio. Lenders look at how much of your monthly income goes toward paying off debt, and yes, that includes this new potential mortgage. Notice that if your total debt payments take up less than 36% of your income, you are in the excellent category. Up to 43% is generally considered acceptable, but if you cross that 43% threshold, you enter the high-risk zone, where lenders might outright deny you or hit you with terrible terms. By running your numbers early, you can adjust your housing budget to ensure you stay safely out of that high-risk penalty box.
Another massive trap? Forgetting the upfront fees. We are talking about closing costs here, which generally run between 2% and 5% of your total loan amount. That is thousands of dollars you need in cold, hard cash just to finalize the deal. There are origination fees from the lender, escrow accounts that need to be funded for taxes and insurance, and the Arkansas Real Property Transfer Tax. A comprehensive calculator tool doesn't just give you a monthly payment, it estimates your total cash to close so you aren't suddenly scrambling for a cashier's check while the moving truck is literally idling outside.
I actually want to pause on this quote directly from our source material because it anchors everything we are talking about today. Successful homeownership requires a clear understanding of the total cost of ownership, not just the sticker price of the property. Buying a home shouldn't be a source of constant financial anxiety. True financial literacy here means aligning your choices with your long-term reality, not just your immediate desires. Section 4. Amortization reality, your long-term timeline.
All right, this is the ultimate aha moment. In month 1 of a standard 30-year mortgage, let's say you pay $1,500 total. Well, only $450 actually goes to your principal. A whopping $1,050 goes straight to the bank as interest. But fast forward to month 360, the very last payment of your loan. The total payment is exactly the same, but now $1,450 is going to your principal and only $50 is interest. Seeing this massive shift from paying mostly interest at the beginning to almost entirely principal by year 30 shows you exactly why making even small extra principal payments early on can shave literally years off your mortgage.
As Dave Ramsey famously said, a budget is telling your money where to go instead of wondering where it went. Running these amortization schedules and testing these numbers isn't about limiting your dreams, guys. It's about taking proactive, intentional control of your finances so your dream home doesn't secretly become a financial prison.
Section 5. Blueprint for Buying, your step-by-step guide.
The calculator is not just a math tool. It is an actionable, step-by-step roadmap to confident home buying. Using it is incredibly accessible. Step 1. Input your total loan amount. And remember to subtract your down payment from the home's purchase price. Step 2. Select a realistic interest rate based on your current credit score. Don't just pick the lowest rate you see online. Be really honest with your credit profile. And step 3, choose your loan term, usually 15 or 30 years. In just 3 steps, you gain immense financial clarity without having to sit through a high-pressure sales pitch from a broker.
Now, an important disclaimer before you rush off to crunch the numbers, online estimates are absolutely your strongest planning asset, but they are exactly that, estimates. Your local lender is the one who provides the final, binding numbers. Things like your actual locked-in rate, specific title charges, and precise local taxes will ultimately depend on a deep dive into your credit, your income, and the expertise of your chosen mortgage professional. But here's the thing. You don't go to that professional empty-handed. You go armed with data, realistic expectations, and a budget you know for a fact you can afford. So the only question left to ask yourself before you start scrolling through those real estate listings is this: are you ready to run your numbers? Because doing the math today is the absolute best way to guarantee you'll love your home tomorrow. Thanks for joining me on this explainer, and happy calculating.